Just a few minutes left in the trading day, about 9 to be precise. It's time for the big picture. Let's welcome in Ann Sonders, Chief Investment Strategist at Charles Schwab. Ann, thanks so much for joining the show.
Hi, Caroline. Nice to be here.
Great to have you. So, Ann, I was just talking with Kevin Green a little bit ago about the technicals, and he was saying that they're looking pretty bullish. But when you think about the fundamentals of this market, are they as bullish? Because there are a lot of headlines for investors to really contend with right now.
Well, certainly the headlines around tariffs, I think, will be a volatility driver. And as we get more details in what is now a lot of give and take, I think there will be probably more precision around companies or industries that are benefits from it or hurt because of it. And I think some of the volatility that we've seen underneath the surface of the market could increasingly be tied to tariff-related news. But yeah, I think underlying the fundamentals look pretty decent, even in this backdrop of technology being the worst performing sector on a year-to-date basis and the give back among some of the Magnificent Seven. You've seen better performance by equal weight relative to cap weight. So I think we still got this valuation risk problem, but you do have a lot of money, I think, looking for opportunities underneath the concentration within the cap weighted indexes, and all else equal, I think that's a positive for the market.
Okay, so I want to talk to you about that valuation problem, but just going back to tariffs for just a second, it seems like the market is really kind of shaking off those tariff concerns right now. There's a lot of skepticism about if they even will come to play, if you will. How real of a threat are they at this point? What should investors be considering?
You're asking me how real of a threat they are, getting inside the heads of the administration? I have absolutely no idea. There's certainly those fully on this is purely a negotiating tool, they won't take effect, and others that do the math and talk about the damage to the U.S. economy, the global economy. The real answer is I have no idea. So we're at the mercy of announcements as they come in. You can do the math if the tariffs go through fully as proposed post-delay. Fed data, Peterson Institute data, Bloomberg data suggests a downward pressure on GDP, upward pressure on inflation. Currency can offset some of that, but then you've got to take into consideration retaliations, but also take into consideration the possibility that delays turn into cancellation if concessions are up to par. So this is the world in which we live right now, and trying to game it, I think many are trying to do it. I'm not.
I was hoping you had a crystal ball, but I guess in terms of the threat, though, to economic growth and then potentially the inflationary pressures and the impact that could have on the stock market, how should investors really be positioning their portfolios given the risk there and given the potential volatility that you've been talking about?
Yeah, so one of the things that we have been focused on for the last couple of years is factor-based investing, not instead of sector-based investing, but at least as an add-on to more monolithic sector-based investing. And in the early part of that focus on factors, we were recommending sort of a basket of quality-oriented factors. So strength of balance sheet, strong free cash flow, high interest coverage. More recently, bringing in both those growth and value components, looking for positive earnings revisions, but also reasonable valuations. I think maybe the factor to add into the mix that could be beneficial from a leadership perspective in an ongoing sort of tariffs, will they, won't they, volatility tied to tariffs backdrop would be lower volatility stocks. It's not quite just saying snuggle up to typical defensive stocks. That's what led yesterday, but then they're at the bottom of the performance rankings today from a sector perspective. But that lower volatility factor may give you a little bit of lowercase d defense relative to some of the volatility associated with tariffs.
So where are some of those lower volatility opportunities, and also how are you factoring in and kind of finding value amidst it all?
Well, I don't do individual stocks, but the good thing about doing factor-based work, screening for those characteristics, is you can apply it to all 11 S&P sectors. There's no one particular place from a sector perspective where you tend to find the large majority of low volatility stocks. You can find it in the higher momentum, in the growthier segments of the market, be it communication services or technology or consumer discretionary. You can also find it in the more defensive areas. So as an overlay to our sector work, and we do have 2 outperform ratings at the sector level, it's communication services and financial. So I think it's the blend of that factor work applied to all sectors, both in terms of where there are opportunities, but also what to avoid. You can do that across all 11 sectors.
Okay, so communication services includes some tech, obviously, and then you mentioned the overweight in financials. But when you talk about the valuation problem, how are you actually looking at valuations at this point in terms of the overall market?
Yeah, no, it's a moving target, of course, because prices change every day, and particularly in an earnings season, earnings change every day. But just in general terms, you look at a group like the Magnificent Seven with a forward PE in the high 20s. You look at the overall cap-weighted S&P with a forward PE in the low 20s. Then you go to the equal weight S&P, and you're in the high teens. So even with equal weight, you're still on the richer end of the historic spectrum. But the one thing I always want to tell people about valuation, it's good to have as a back pocket sort of issue from a knowledge perspective. It can represent a backdrop risk, but valuation is a terrible market timing tool. Not to suggest that there is any really good market timing tool. There isn't. But valuation, if you have a 10-year look forward and you were to track starting PE ratios on a forward or a trailing basis and then look at subsequent 10-year returns, there is a correlation. So I think valuations can help you in trying to gauge longer term returns. But if you do any starting point PE, forward or trailing, and then look at subsequent 1-year returns, there's almost no correlation. So valuations can get rich, get even richer, get more ridiculous until something happens. There's a catalyst, something maybe even sentiment driven. So it's more of a back pocket thing to be mindful of, as opposed to sending some moment in time signal of either get in or get out.
All right. Ann Sonders, Chief Investment Strategist, Charles Schwab. Always appreciate your insights. Thanks so much.
Thank you.